Good morning, everybody. Thank you for joining our webinar. Month end coming up, quarter end coming up, and it's a bull market. It really is. It's great. I'm very, very optimistic, shall I say. Slow, steady, nothing crazy. 2 years of a bear market, and it ended October of 2022. So this bull market that we are in is about 18 months old. Typically, a bull market will run for 3.5, 4 years, give or take. Tying into the presidential cycle, the last year of a presidential term, i.e. this year, and the first year of a presidential term next year, regardless of presidency, market tends to do well. So I do think we got at least 18 months of significant runway in front of us. And you're seeing in the market, breadth is widening out, which means more names are participating, beyond the Super 7 or Fantastic 10 or whatever they want to call them, from FANG to magnificent. So anyways, you are seeing breadth in the marketplace. I just want to have a little fun with you, and share with you what we own and what we are watching, and also share with you what is not working. Just for interest and curiosity's sake. So I'm going to go through our watch list. It's about 400 names, and we'll just dance along here. I'll show you some names here. Here's the stock that we own, Airbnb. You see the picture of it. Unanimously looks higher to me. I'm sure you would all agree. We own the stock. Applied. I'm in the wrong chart list, so I can back up here. I don't want that. I want to show map position, mapping ideas. I was wondering they're all RD. Here we go. Now we go. So here's 400 stocks. So here's a stock we do not own, Agility Technologies. Tech stock, don't own it. Apple. This is an interesting name. It was a magnificent 7. Probably it still is based on valuation. It's a $2.6 trillion company. We sold Apple. I don't know where, roughly around here. I'm circling, give or take. We sold it probably twice out of the trade for some time now. As you can see, trend is broken. That's called a double top. Could be called a head and shoulders formation as well, depending on who you want to speak to. It doesn't matter. 50-day moving average across the 200-day moving average is bearish. Stock trending lower as the market is going higher. Hard to see the market push higher without Apple. For a long time, as Apple went, so to the market. But it's decoupled from that. The market is higher as Apple is broken down. So the market can work without Apple. Thank God we're out of the name. But this just shows, there's a time to own them and a time to fold. And I'm glad we folded and moved on to greener pastures. Here's an interesting company. It's in the electrification business. I've been watching it for years. I continue to watch it. ABB is the name of the business. AbbVie, drug company, looking interesting. Paying attention to it, don't own it. Airbnb, we own this baby. Just talked about it, pointing higher. Abbott Labs, healthcare stock, not working on our watch list. AECOM, engineering firm, industrial firm, looking okay. We own S&C Lavalin, and we own Stantec, same space. So again, I like to pay attention to sectors to see if names within a sector are acting the same, see some decoupling, etc. Here's a good tech stock, IT outsourcing company. I've been intrigued by the name, haven't purchased it yet. Broke down, no need to own it just yet, bouncing off for 200 days. So again, on our watch list. Again, this is where the new ideas come from. Adobe, a name we own, made money, sold it, topped out, broke down. So no need to own it yet. Excellent company. One day we will circle back to it, just not here. Another tech stock, don't need to talk about it. Automatic data, just an interesting old school economy. It is a data business used for multiple tools, including employment records. Anyway, stock's going sideways. No need to own it. Autodesk is a cool one. Play on building, a play on automation, a play on technology. We sold the stock. Looks a little sideways to me. I like the business. I want to buy it back, but I don't think it's going to necessarily work better than other names we do work. You can see something called relative strength over here. It's performing better than 52% of the stocks in the S&P 500. I prefer buying stocks with more relative strength than that. Aflac Insurance Company. We own Progressive Insurance. We own Hartford. Insurance looks good. Again, I get confirmation on my trades when I see other names in the space working. So insurance stocks are working. AIG, another insurance stock. Look at it. Beautiful. If I had more money, I would buy that stock. Another insurance stock. Here's a tech stock, Akamai. not working. Better tech names to own. Probably get some support around here, but don't own it. Don't need it. AltaGas, one of the few Canadian utility stocks that looks pretty interesting. Don't own it. Another tech stock, don't own. Insurance stock, Allstate. Look at it. It's amazing, isn't it? Sector by sector, with the names within the sector all doing the same thing. Confirmation either up or down. Semiconductor stock, sold some yesterday, a little trimmy. Had a great move, made a lot of money. I still like the name, but it could be getting toppy. Got to be respectful of that. Time to own them, time to fold. So we've trimmed the name, still holding. But if tech continues to show pressure, I will continue to lighten load. If this stock were to break this number over here, come below 189, I'll probably exit the trade. So things I'm paying very, very close attention to. We already sold AMD, bought it, made some money pretty quick. Not a lot, about 10%, whatever. It broke the 20-day moving average. That's the first sign of support. Now it's breaking the 50-day. It looks lower to me. Don't own it, moved on. Going to pay attention to it. It's a great name. Amgen, biotech company, probably one of the best on the board. One day I will put this back in the portfolio. I don't, again, on a relative strength basis, there are better names to own, according to my SAA report, but it is of highest quality, so I do at some point, I'm willing to buy it at some point. Here's a cell tower stock. When real estate was all the rage, unique, I don't know how to phrase this properly, but all these esoteric versions of real estate came to market. That's what happens in crazy bull markets. Late at the end, all the weirdest stuff that you never could have imagined actually comes to market. So from storage REITs, industrial actually real, but storage REITs, this is cell tower REITs. So telecom towers on top of apartment buildings, and they long-term contracts with the landlord. They then lease out these cell towers to the telcos. Anyways, it got a lot of interest in it, but at the end of the day, it just became a regular business. But very, very tight in what it offered. And if the sector goes cold, it's in big trouble. It's not diversified as far as real estate goes. So anyways, no need to own it. Amazon, look at that chart. Gorgeous. Would you not agree? We own it. We're long, we're strong. Continue to hold it. Aritza Networks, beautiful chart. Love it. Again, semiconductor stock, little pullback. It was 310, it's 286. We have about a 2.5% position in it. I'm respecting the trend, but again, if we're to break over here, I'd be exiting the trade. Definitely if it breaks the 200-day, I'd be so if you have really, really bad earnings and it came down and broke that line, I'd be so gone. But for now, I'm following trend. Another insurance stock looking interesting. Here's an industrial stock. We own industrials are looking really, really good. General Electric, builders, Stantec, industrials are on fire right now. And we've built up a nice industrial portfolio. Here's an energy exploration company, Apache, not working. Air Products, there's an industrial that's not working. They're in the gases business, but it's not working. Amphenol is in the electrical business. So anything electrification is working. There's an idea. Apollo, private equity firm, probably the best of the bunch in terms of working. Blackstone is my favorite. This one's insurance. This has big exposure to insurance. Thank you, Jack. So again, this is a good point. This is tying into the insurance strength that we are seeing. Oil stock, Canadian, one of the best without question. We just bought some Imperial Oil and some Meg Energy in our TSX quant strategy. In our growth strategy, we don't own any oil. We don't have very much Canadian dollars in our growth strategy. I don't like the Canadian dollar. I don't like the Canadian market. But if you have to buy something Canada, which we do in our TSX strategy, oil is certainly something that is working right now. ASML, tech stock, we sold it, made a bit of money. Looks sideways to me, so it's against the semiconductor. We lighten the load on the semis. Couche-Tard, sold that baby, made some good money. We sold it in and around here. And of course, stock subsequently went lower. It's gas stations, nothing fancy about this business. And when there's nothing to buy, when there's a lot of uncertainty, booze and smokes sell. So this company sells smokes, they sell gasoline, they sell chocolate bars. And apparently with the economy slowing, consumers aren't buying as many chocolate bars at Circle K. They better off getting them at the dollar store. And they've actually talked about that on one of their conference calls. So I found it interesting that they're actually speaking about chocolate bar sales. Anyways, we made money, moved on. Here's S&C Lavalin. I do have a very funny story off here. I can share it with you on this company. It's personal. But nonetheless, Haven't owned the stock in years, bought it way back when we were at RBC. Start to catch up with WSP Global, which is an engineering firm, participating in the Stantec play. Again, this is all about global infrastructure, global growth. What's that act in the United States called, Jack? That's
the CHIPS Act, the Infrastructure Act. Yeah,
Right.
lots of fiscal spending from governments, especially in the U.S. And these Canadian companies have exposure to the U.S.
ATS Automation, don't own it. It's a good company in Canada for sets up automation for manufacturing. Stock was working, not working. And again, you can see there's a time to own names and a time not to own names. Plain and simple. Broadcom of Vago owned it, sold it, made money. Coming around the outside, we probably still, I'm not sure where, rough, maybe here, give or take. Snap back. We'll see how it plays out. Great company. Don't own that. Here's a water company. It's a utility in the United States. Great business. Not working. No need to own it. Paying attention. Don't know that name. AstraZeneca Healthcare, as you can see, not working. Trying to turn the corner. No need to own it yet. AutoZone. Automotive in the United States is interesting. Car parts continue to work. Online auctions continue to work. Car dealerships and car refurbishing continues to work. So it's a very interesting subsector of consumer discretionary. Boeing not working because they keep having doors fly off their planes in mid-flight. Again, we owned it, moved on real quick. It didn't work, cut the loss, moved on real quick. Thank goodness. Again, when they get into trouble, cockroach theory, there's never just one cockroach. So the sooner we get out of a losing trade, so much better for everyone involved. Sitting with losing trades is not the way to make money. Cut them early, cut them often, stick with the winners. Bank of America. Yeah, in the sideways forever, waking up. The U.S. banks look better. Canadian banks maybe playing catch up. They're lagging, but the U.S. banks look good. So we bought more Bank of America yesterday. Brookfield Asset Management, core holding for us. It's had a good move, made some money. Looks a little sideways to toppy. No need to sell it yet. Getting paid a modest dividend of the highest order in terms of management. Probably one of the best companies in Canada. And there's unfortunately not a lot to choose from in Canada. Healthcare company that's where Jack's wife used to work at Baxter.
That's right.
Was a great company, MedTech, worked for a long time and then stopped working. And when they stopped, they stopped. Went down, trying to come back. It looks better, but again, it's not the first healthcare stock I buy. Here's retail. I'm not a fan. We'll let it go. Bell Canada. Oh my goodness me. Widow and orphan stock. That's what this was once called, a widow and orphan stock. And that meant you could buy it for widows and for orphans because they had nothing to worry about. Yeah, right.
It's a widowmaker now.
It's a what?
Widowmaker.
It's a widowmaker. But it's just making new lows. It's unbelievable. And guess what? So was Rogers, so was TELUS. So the space is cold. That's also part and partial to therefore why the cell tower REITs aren't working. So don't need to own it. Yeah, you get paid a dividend. So it pays a juicy dividend. And I'll just share that with you.
That it doesn't cover.
That it doesn't earn, which is also very, very good point. But the divvy on it, I think it's 8%. It's huge. Okay, so dividend is 8%, and the stock was 65, and now it's 45. So you're down 33% in capital. Take you 4 years to get that back in divvy to be even on the trade. So these high dividend payers are terrible investments from a probable speaking point of view. In other words, the likelihood over time of underperforming is by buying really generous dividend paying stocks. Ultimately, they cut the dividend. Often they don't earn the dividend. Often there is a family incentive like Chorus, where the family has multiple voting stock. They control the vote. Don't have to worry about the equity. Collect as much dividend as they can until they milk the company dry. That's not happening at BCE, but I've seen it happen in other companies.
Often, the other thing too, often the price comes down, which makes the dividend look more attractive because they don't cut the dividend, and they're still not cutting the dividend. So price going lower, as Wolfgang said,
takes the yield higher.
Not cutting the dividend gets the yield higher.
Yeah. Here's another healthcare stock. High quality business not working. Paying attention to it. Again, I want to own them when they're working. I don't want to own them when they're not working. Brookfield Renewable, they're in the new renewable power business. It was a darling forever, and then it goes cold. Here's an ag stock. Again, I'm paying attention to Bunge. It's trying to turn the corner. So they're in the nutritional business and the likes, similar to a Nutrien. We cut Nutrien, thank God. It's been dead money since. So I'm watching the space because I do like the space when it works. It's not working yet, but it's starting to warm up. Base metals, like copper stock, so not working. Stock was 60, it's 56. And commodity stocks, if anything else, they need to be traded. So I could buy BHP down here and hoping for a action up that way, but no, the trend is not up. The trend is sideways to lower. I wouldn't make that trade. I'd rather buy something that is working. I'd rather buy this stock over here and try to get some of that action out of it, and then maybe sell it over here and get a piece. So there's money to be made in short order. Another biotech stock not working. No need to own it. High quality business just not working. Market doesn't want it. Therefore, nor do I. Bank stock is working. Bank of New York. We don't own. We own others. Here's Booking. We sold this stock. I don't know, somewhere around here. Went lower, coming back around. The high quality business. I do like it. I got shaken out of the trade, but we made very good money. Who cares? Very good money. What was that, 30-40% on that one?
It was a good trade.
It was a great trade. It was a great trade. So we got a fantastic piece of it. And I'll get another shot. And if I don't, I don't. But this name we bought recently, and we keep adding to it. And as you can see, it's working. They are in the buildings material supply. So U.S. housing starts are at around 600,000. The peak of U.S. housing starts of several years ago was, I think, about 2.4 million. On average, America has to build at least 1 million homes just to maintain decline rate, obsolescence, and immigration. So they have been underbuilding. The U.S. building industry looks really, really, really good. Problem is builders aren't as incented to build with interest rates being as high as they are, but they have more flexibility and more wiggle room as a builder in America than they do in Canada. So anyway, building looks good in the United States. Canadian Bank, Bank of Montreal, trying to work, don't own it. Here's the other Brookfield. There's two of them. Same company, just slightly different flavor. Bank of Nova Scotia. So again, Canadian Bank's finally waking up. You're seeing some action on that one. Healthcare stock looks decent. Boston Scientific, don't own it. Here's a coal stock. Coal was working so well 2 years ago, went quiet. Now it's gone sideways, but the world still uses coal. Not buying it. I like to pay attention, that's all. Here's another consumer discretionary stock, which we don't own. Private equity, Blackstone. Canadian company, automotive repair, body shops. Consolidator, US primarily, some Canada. Was a darling stock for a long time. Little weakness. Maybe I'll buy it if it pulls back into here, because again, it's hard to find Canadian names. There's a good one. But right now it's gone cold, so I continue to wait and see if I can buy it one day. US Bank, Citigroup. I should. This one I'll probably buy soon if I have some cash open up. It looks much better. Canadian aerospace stock not working. CAE. Cardinal Health working in the United States. Carrier Heating and Air sideways. Caterpillar breaking out. That's good. That's all, industrial equipment. Insurance stock, another one, higher. We sold this stock over here. I think we made a very good exit on it. Stock was strong for so long. Eventually, they have to go weak. So a bit of an early exit, and I think the exit was good. I think CBOE works its way to maybe $1.60 or so. So high quality business, but at some point you got to take profit. Another real estate stock, semiconductor stock, Cadence, we own it. Looks decent. Again, if it breaks over here, I'll have to cut it. But as long as it maintains trend line, I continue to hold the stock. The name of the game, as far as I'm concerned, is if they're going up, hold on to them as long as they continue to rise. And when they break, get out. And it's working. Another ag stock going sideways. There's a trucking company that's not working. Charter Communications not working. U.S. Cargo jet, transport stock, mixed results on transports. This is working. Consumer discretionary looks better. Kimberly-Clark looks better. Colgate looks better. Back to consumer staples. This would be a play on what, Jack? Soft landing, slow economy.
I would say that they're defensive stocks that benefit from potentially lower interest rates.
Lower interest rates, yeah. Right. Lower. So then again, for the theme that Jack pays attention to this macro more than I do, but basically the theme that Jack's paying attention to is high interest rates, slow economy, growth stocks are in play, i.e. technology. If all of a sudden the economy improves and interest rates soften, then value and more fairly priced stocks will perform better, likely at the expense of technology. So there is this real ebb and flow between value and growth, risk on, risk off. And we are barbelled in our portfolios, but every 6 months or so, I'm moving slightly left and right, and probably a little more in the last 6 months than normal, just because there's been a lot of talk of if interest rate cut, then they don't come. market goes back. So they are speaking of 3 rate cuts this year in the United States. I will not be surprised if they cut less than 3. I think they're sort of obliged to cut 3. But if the data remains firm, that the economy remains firm and inflation is stickier at 3%, we'll see.
I would say the further you get into the year without a rate cut, because it is a presidential year, the less likely that they continue to cut through the election.
Yeah, they will be cutting through the election, right? Yeah. They don't want to interrupt.
And right now, the economy is strong. GDP was stronger than expected, and we'll see what comes out in the near future. But in that situation, as long as inflation is coming lower and growth is continuing, they have no reason to cut rates.
CIBC, we just recently purchased this stock in our TSX strategy. It looks better. Here's another stock exchange. This one's interesting. Here's an industrial company, Cummins. They make engines for transport trucks. And again, as I say, trucking is on fire. The rails look tired, but trucking is working. We also own Peterbilt trucks. The company's with the symbols PCAR, PCAR. We own it. You'll see the chart. It's working. So it's just interesting how some sectors are showing really good strength. Other sectors are mixed, and some sectors are just down on the mat. Real estate probably still down on the mat, as an example. Here's an oil stock, one of the best in the world. We owned it, sold it, left it alone. It's gone higher since we sold it. Big deal. It does look better. It is one of the best in the world. Not easy to play. That was CNQ. Here's a railway stock. I wish I never sold this stock. It is a great long-term hold, but every now and then they go cold. But it is a great company, CNR and CP. They're 2 excellent businesses. You do have a little bit of exposure to crypto. If any of your kids trade crypto, tell them a little gently that you're on the crypto trade with them, drive them crazy. Coinbase Global, it's the world's largest exchange to trade crypto instruments. A lot of ETFs have been created around crypto. They have to basically trade on Coinbase. It's a real business. It makes money. The stock was significantly higher when it came to market a couple of years ago. I suggested probably about, we'll tell you, I'll take a look at the screen here, bear with me. Yeah, the stock was $430. So it is $260 today. We bought it at $190. We bought it right about, so Matt, right around here. So we're up significant in the trade, but I think this thing can go. I also think crypto will get to, or Bitcoin will probably play with that big even number of 100,000. Markets like to go to big round numbers. They just do. Call it gravitational pull. It's like human psychology. I don't know. I do think Bitcoin, which I'm not buying, and I don't advise you buying it. I think Bitcoin goes 100 grand, simply just because. Momentum will do it. If it goes 100 grand, this Bitcoin will make new highs, or this Coinbase make new highs. So it's one trade that we have on it, and I monitor it. Another oil stock is Core healthcare stock, looking good. Don't own it. Here's Costco, great company. Y'all shop there. I'm sort of mixed on it. It's not the best idea to have, but it's a good, high quality business. And at some point, we may buy the stock. Don't own it right now. Just watching it. Our other railway, CP, which we don't own, but it looks like it's pulling back. We own this one, Copart. So again, it is an online auction site for automotive, making new highs, all-time highs. That's what I like. I like companies that make all-time highs. I buy more. I said I'd buy more. Pay top dollar. That's right. I like to buy stuff that's expensive. There's Salesforce, CrowdStrike, internet security. Yeah, that's not a real industry. So we own CrowdStrike. I trimmed a little bit of it. Made a lot of money in this name, but I did trim the name back a little bit just to be prudent. Cisco, we don't own. Carlisle, another industrial, we own it. Look at the chart, gorgeous. Constellation Software, Canadian tech stock, working. We own it in our TSX mandate. Here's another railway stock. As you can see, peaked, lower. So you're seeing the same action in these rails in Canada and the United States. Peaked, lowered. I don't know what that means because trucking continues to work. Oh, Cintas, hello. This is our winner of the day, by the way, friends. So we bought this stock. Look at that trend. Company came out with earnings today. Poppy Poo up 10%. So stock has just made a new all-time high. Uniform company.
That really speaks to the employment strength in the U.S. Like Wolfgang said, employment company, rentals, job growth remains strong, employment remains strong, GDP growth remains strong. It's a good barometer for how the U.S. economy is doing.
I will say something else. If you look over here, here's the price earnings ratio, 50. This company is trading at 50 times earnings. Now, earnings get adjusted upwards, so maybe it's down to 40. Canadian banks trade at 8 and 9, call it 10 times earnings. So you say, why would you buy a stock that's so expensive? I tell you something, because expensive stocks make you money, cheap stocks don't. I cannot stress that point enough. It's amazing. Expensive stocks make money. Here's another name, another energy stock trading at 12 times earnings, as you can see. Here's another tech stock, don't own it, just watching it. Healthcare stock, watching it. Oil stock, watching it. Airline, boy, they're traders like you're going to rent the seat. Not easy to play. No need to buy this, but it's interesting. You know, travel looks good. If the airlines work, the booking will work, the Airbnb will work. It's all the same trade. Just airlines are just harder to trade because it's so capital intensive. Caterpillar is making all-time highs. John Deere is farming equipment. Food prices are falling. I repeat, food prices have fallen significantly. Everything but chocolate. Cocoa is now $10,000. I think it's a ton. I think it's at an all-time high. So for some reason, chocolate's gone parabolic. Jack thinks maybe it's a supply and not demand issue, right?
Well, it's just a guess, but yes.
It makes sense because I don't.
Ozempic.
Well, yeah, that's just it. So, but maybe they still got that great. Like I love chocolate. I'm a big chocolate fan. Anyways, so farming went quiet, but as you can see here, it's got a bid. It's waking up. It's turned the corner. So I may buy this name. I'll have to look at my momentum screen, relative strength to other names, and make my decision based on that. Good old Dell woke up. I think we may have talked about this stock a few weeks ago. Was quiet, all of a sudden it worked. Here's a booze stock. This is Guinness beer. I was in Ireland last year. I went to the Guinness factory. Loved it. Loved the brands. Loved the marketing. Stock not working. So I gotta be careful. Love the brand. Everyone drinks Guinness. You know, I can say all kinds of nonsense and stupidity. Market doesn't care. That's the most important thing. Not what I think, but what the market thinks. I don't like Tim Hortons. Market's taking Tim Hortons higher. I like Guinness. Not out of can, by the way. If you go to Ireland, you must go to the factory. The Guinness there is delicious. Home builder. There you go. Look at the home builder. But lots of volatility. I hate these stocks. But it's in our quant strategy. That's the beauty of our quant strategy. It takes my own personal biases, Jack's biases, analyst biases out of the equation, and it respects pure market forces, the ultimate arbiter of value. Danaher, here's a healthcare stock, high quality, not bad. Disney, we just bought it. Disney's streaming apparently going to turn the corner. Theme parks are looking better. That's all the excuses for it. Who cares what they are? Right here's the action. Volume spike. Stock gaps up on earnings, makes it a little high, comes back a little high. Bought the stock right about here just the other day. It looks great. This thing looks really, really good. And if it rolls, I cut it. I'll manage it. But so far, so good. I'm going to probably buy more of it. DocuSign not working. Dollarama sold it, made some money, moved on. It's just dollar stores. Skidoo. I can tell you a funny story about that, but I'm not going to. Not working. I'm going to skip through a few here. Here's a high quality Canadian company that is working logistics software. We don't own it, but we are paying attention. Duolingo, my daughter's learning to speak German. $6 billion company. I don't understand. One trick pony. I don't understand. Stock's working. I don't understand, but it's working. The market likes it. So I like to watch it. It's cool. eBay's woken up. That one's interesting. I forgot that they used to that a payment services company. Jack reminded me of that. They sold that. These only PayPal, right? They own PayPal. Yeah, they sold it off. Anyways, this thing woke up, eBay. Gap up over here, and it looks interesting. I got to respect it. I don't own it yet, but I have to respect what I see. Ecolab came out, I think, with results. Great company, soaps, detergents. Estee Lauder not working. Elf Beauty was. There's Elf Beauty. We made good money. We can thank my daughter for this trade here. She's 16. She's right into mascara and makeup and is late for school because it's more important to get the makeup right than to be on school. I kid you not, drives us crazy. And anyway, she's always going to Shoppers Drug Mart and buying this Elf because this stuff. I look, there's a stock. I look, wow. We bought the stock, bought more of the stock on strength, sold it. I don't know, 35% return in 6 months. Thank you, Siobhan. That was my Peter Lynch move. Peter Lynch book, One Up on Wall Street. Pay attention to your kids. They'll get you on some really good trends. Elf Beauty was one of them. I'm just going to go a little quicker here. Just get some stocks I want to talk about. Eaton. We own this. Electrification of the world. Gorgeous. Look at it. Just beautiful. Beautiful. Makes a new high, pauses, new high, pauses. new high pauses. Gorgeous. That's what I want to, this is what I want to do. As you see here, every stock I showed you that we own is working, which is the name of the game. If it's not working, I got to get rid of it. We bought that energy play. Just bought it recently. We'll see how it plays out. But you know, it looks okay. It looks a little toppy. You know, some overbought conditions on it and the likes, but I'm respecting it. So far, we're okay. Just bought this industrial company. They're in the fastener business. So if you need some brackets and some, I don't know, what are the kind of fasteners, Jack? Used to have the machine shop. Anyways, so BHP Billiton copper company not working. Freeport, another copper company working. Divergence there between the two. But whatever, I say the stock's toppy. You sell at 50, you buy it, or you sell at 45, you buy it at 35, or avoid the situation. I'm avoiding it. Don't need it right now. FedEx, something happened there. Earnings came out, stock popped finally. That was dead money for a long time. We own this stock. It's in the plumbing business. Plumbing supply, is it retail and industrial? Retail and
plumbing supplies.
Jack got this idea on the weekend reading Barron's, came into work, talked about it, looked at it, put it on our watch list. I don't know, maybe 6 months later bought it.
Yeah, it was recently added to the S&P 500. That's why it was highlighted at Barron's. Got on our watch list and then followed it and then pulled the trigger maybe a month ago.
Yeah,
like that.
But we watched the name for about 6 months, 8 months, did some work on it, paid attention to it, and bought it. Fairfax, we own that name. Beautiful chart, as you can see. Here's a name we've owned a couple of times, never made money on. Digital payments, fintech, love the space. You just got to sometimes catch them right. You catch them wrong, it is what it is. FICO sold it across the book, right?
Yeah, that was another name that was recently added to the S&P 500 about a year ago. That's what got it on our list. Watched it, traded it.
We made a lot of money on it. Great profit.
Yeah.
Look at the PE ratio. This one here is 71. Okay, so expensive as heck. Made us good money. That one's working, by the way. Here's another HVAC type business. So industrials look great, and again, I'm delighted we got them. Here's that industrial company, HVAC, heating and air. Another industrial name in the meters business, so measuring flow of liquid and gases and whatever else. It's working. We don't own it, but I'm watching it. This one's funny. I don't own it, but I'm watching this thing. Fresh Pet. I don't know if any of you purchased from Fresh Pet. I got a dog, but we don't. He's my gourmet food, along with Kibble. There's a cute little guy that he is. But this Fresh Pet, you basically buy this stuff online or at various retail stores. You know, their own recipes, healthier, more organic pet food. But your brother-in-law says he buys it right. He says,
I don't know if he buys that one, but it's frozen food he buys.
Is this a big tub of crap that you scoop up for the dog?
Yes.
Yeah.
It's a lot of work.
It's a lot of work to scoop it out. It sits in your fridge, big container.
Freezer, yeah.
In the freezer. Yeah, that's what I want. I want dog food in my freezer. But yeah, I had a friend of mine who put his dog in the freezer. That's a whole other story.
After it passed away.
After it passed away.
To be clear.
Yeah, his deep freezer. There's an old stock that we traded. What else you got? Here's Finning. So Caterpillar working, Finning, Canadian stock, equipment company not working. It's General Electric. Dead in the water, dead on the floor forever. GMAC paper, which is their debt, became their finance business became too heavy. Financial crisis put weight on them. The company was a bag of hammers. What they did was a restructure. When a company restructures, Air Canada, General Electric, I don't know. There's lots of examples. You buy after the restructuring because they tend to be cleaned up and have a chance to make money, and no one's in the name. No one owns General Electric right now. In other words, it's so under-owned. But they cleaned it up. They separated healthcare from their industrial. They got rid of their finance business for the most part, to the best of my knowledge. The stock was working. Hard to buy this old industrial because GE. We bought it. It's pushing higher. So we're long, we're strong. This one trades at 20 times earnings. Again, I like the more expensive names, but nonetheless, I was going to move along here, so I don't want to waste too much of your time. Google looks interesting. We made a lot of money in this name, took profit on it. It hit the 200-day, bouncing back. It wants to reaccelerate. I may reload the trade. Not yet. I have no cash. I don't want more tech today, but again, it's on my list. I can always just paper. We can buy it. We can sell it. We want to make money. Garmin, that one's good. I thought Apple was going to put out a business with the phone, but obviously not. For navigation, sailors and pilots. Tony Dwyer said, well, but I would not dare trust my cell phone for navigation.
No.
So no. So he made a good point. Eh?
No.
Like this thing was $100 forever. Garmin. It's just a cool company, but we never bought it. We watched it, came close. Let it go. Goldman Sachs, we own a little bit of it in growth and balance. Balance and conservative. Not the most exciting financial, JP Morgan, Bank of America, Citigroup look better, but I love the highest quality nonetheless. GlaxoSmithKline, not my family pharmacy, but it looks good. You got to respect, may buy that. We sold Great West. Here's another parts company in the trucking industry. We own it. Look at it. It's beautiful. Yeah, it's equipment, all kinds of stuff. Hydro. This one's breaking. I am going to hang on to it in conservative, and I think Balance owns some too. It is a utility. This one I'm holding fundamentally. So I'm not going to worry about the charts with Hydro. Simply being, I'm a customer. They will jam me every year and raise rates every year like dictators because they can do that. Obviously, the world's going electric. So, thematically, I don't think there's a lot of risk in the name. Maybe the stock goes down to 37. She'll bounce back and go higher. So this one I'm actually holding different. I'm going to break some technical rules and hold it fundamentally. Get our dividend. The dividend will grow every year. Mark my words. I will bet anyone lunch. Dividend grows for the next 5 years every year, or I owe you lunch. You just got to pay attention to the trade. But they're going to raise rates. They just keep raising rates. They can do that. Well, what are you going to call the competition? What else? Home Depot looks interesting. Don't own it, but I do prefer the other building stores over Home Depot. But it is reaccelerating. Insurance stock that we own. Look at that chart. Like, which way is this? This is the stuff I want to own. Right? That's what I want to own. Where it stops, anyone's guess. It trades at 12 times earnings, pays as a dividend. It's a $30 billion insurance company. The trend is your friend. I want to buy Hilton. Gorgeous trend, travel, high end. Don't own it. We own Marriott. This one looks a little better. I was tempted to trade Marriott for Hilton. Sort of 6 one, half dozen the other. I said chocolate, cocoa prices higher, Hershey lower. We bought Hershey. We sold Hershey. I can't remember what we paid for it. I can't remember what we sold it for. It was a plus or minus 4% trade. And we plus or minus it somewhere around here. Thank God. When it's down on the mat, get out of it. When it turns, we can buy it back. But as you see here, this stock, I have no idea how long it's going to stay down here. If you're holding it down, you're not making money. I think you all want me to make you money. So that's the reason why we get out of trades, because when they break, and it can be a long time to repair. And once they go, they go. Here's a stock that's working. Industrial name. That works. Don't own it. IBM came back. Isn't that fun? Good old Big Blue. Here's the name I want to buy. Don't own it yet, but this one looks beautiful too. Another industrial buildings products. I do this every day. This is what I'm showing you. I already did this morning. I come back to this list again today. This is what I do every single day. I look at all these charts, plus another 600 on top of it. And you do that every day. These things get ingrained into my little brain. And so I begin to see patterns. And I use other data and see if I get confirmation on that. Then you read reports and blah, blah, blah. And you make decisions. This is what you pay us for. Canadian insurance stock. Good name, not the easiest to hold. It was, 230, now 220. Intact Financial, very good company. Don't own it. There's another hotel stock. Imperial Oil, we bought this one, very high quality oil stock. There's the paper company, Ingersoll Rand. Look at that, we own this. Look at this chart, it's gorgeous. They're in the compression business. If you drive around the city, job sites for construction, you'll see a great big machine running, burning some diesel, or I don't know what it burns. It burns diesel, is it?
Yeah. Sure.
Anyways, producing power.
Generators.
Yeah, but it's compression, right? The compression gas. It's whatever. Iron Mountain. I want to own this one here. Paper shredding company. They call it a real estate stock. Basically, it's document protection, document storage. I guess both old school and new school. I guess you do digital storage as well. Do they, Jack?
I don't know.
But they come into our building every day. They collect our paper. They shred it. They take it away in lock bins. Look at it. It's just amazing. It's just working. Sounds old school, but it's working. This is an Intuitive Surgical. We owned it, didn't make money. Just sold this stock for clients. Why to sell it? It looks toppy, a little tired, not moving any higher. Good name. IT Consulting. Very, very good company. Johnson & Johnson. High quality company, not working. No need to own it, which again is just my point. So it pays a 3 dividend, whoop-de-doo. Stock year to date is down 2-3%. The S&P 500 is up 9. Our quant is up 18. Our growth is up 10. Yeah, great brand, not a great stock. Great brand doesn't mean great stock. Here's a great brand, great stock. I want to own it. Guess what? I do own it. JP Morgan. Private equity, looking good. Semiconductor, once again, working. We own it. Trimmed a little bit, but we still got about 2.5% weight. As long as it continues to trend, as you see, we hold it. If it breaks, we sell it. Kimberly-Clark Consumer Staples, toilet paper. I guess we used up the last of our rolls from COVID over purchase. Stock went quiet. No more buying toilet paper. Finally, I guess people had to go to the bathroom still. Toilet paper back in the year. Toilet paper. Anyways, it's interesting. And it makes money. Coke going sideways. I guess the diets hurt the Coke for a little while, but guess what? It comes back. Loblaws working. Lennar. Do we own that in the S&P, don't we? Home builder, Lennar? We do, yeah. We do. Home construction. So here's the name that our quant strategy bought. I would never bought the stock. Our quant strategy told us to buy it. We respected it. We bought it. We're making money. Here's Lennox working. Lindeen working. Lilly we own. Lockheed Martin. What time is it? 2. That's good. Yeah, I'm going. So I want to stop here with the charts. That's halfway, barely. There's 500 in this list, so I don't want to continue. But the names we own have clean charts, are all working, period. I'll show you something else that is really cool. If I may, stay with me. Here's our growth portfolio. You see the green? These are the stocks that we own. Every single stock we own is up. Unbelievable. Canadian stocks, it's what we own, up. Every single name we own is up. That will change. The market gods are about to smack me in the head, but I have to share that with you. Here's our quant strategy. Look at the position. Applied Materials are up 87%. And we've held that for 11 months. Arista Networks up 54%. We've held it for 7 months. Not a loser in it. Again, we've had losses. We take them, move on. But hang on to the winners. Look at this. Pulte Homes, oh my God, we're up 102% in that stock. I would never have bought that stock. So this is the benefit of the quant strategy. And this strategy is kicking it. So here's our TSX quant strategy. It has 3 small losses in it. There's
Two of them were just bought.
Here's a Bloomberg strategy. Jack's running a bit of money in this one. This is not technical, it's pure fundamental. It's working pretty well as well. And year to date, here's how the market's doing. Toronto is up 4.9%. The Dow's up 4.8. The Nasdaq 8.5 in US dollars. The S&P 9.3 in US dollars. So I repeat, call it 5 for the old indexes, 9 for stuff with tech. How are we doing? Let's go right to this here. Here's our growth mandate. Year to date, as of yesterday's close, up 10.5% net of fees. Our quant strategy. So there's information on the strategy in front of it, and then the actual performance as of yesterday. Our quant strategy. I hope you have some of this, my good friends. 18% year to date, 17 in this period. That's a 12-month return. Put those 2 numbers together. 35% 12-month return. Wow. My life work right there. This is my life work right here. I'm so proud of that. I have to keep doing that, knocking on wood. There's the Canadian strategy. Again, the Canadian market's up 5% year to date. This is up 7. No, 7 is better than 5. I hate Canada. I don't like it. I don't like it. Here's our balance strategy. That's got about 20-25% bond stock, so it's doing 7. We're trying to make 7 for the year in balance. So far we're up 7. And conservative, where we're trying to make 5 over a year. Year to date, it's already up 5. So our mutual fund, by the way, here's our mutual fund accounts. Is what? How many funds in that, Jack? 3? 5. 5 mutual funds, 5 equity funds. So Jack manages the fund, this particular account. We don't have a lot of money in it. It's just for our little accounts. But people say they don't like mutual. It's doing fine. A mutual fund account. You buy the right managers and you know how to manage it, what Jack does. Excellent. So across the business, I can't tell you how happy I am for the work that we're able to offer to our clients. Everything we do is proprietary to Jack and I. These are our processes, exclusive to the Wolf on Bay Street. So this is working like a charm. I'm so pleased. But the one that really stands out, obviously, is this new quant strategy. I continue to advise clients to take as few bonds in your portfolio as possible. If you're in the conservative mandate, depends on your situation, how much money you have, but try to move the conservative mandate to the balanced mandate. And if you're in the balanced mandate, try to take as much of that money and put it towards the growth mandate. I continue to say stocks over bonds. I've owned bonds for clients for, I don't know, 15 years. Honestly, they've been of no real value to me. I can't say they really did the work that they were supposed to. When the market goes down, bonds are supposed to go up a little bit. They really haven't a whole lot. They haven't offered us a lot of buoyancy in troubled times. And you can measure that in standard deviation, which we do show on our reports. You should get a slightly lower standard deviation holding some bonds. So, for example, the growth mandate standard deviation on this portfolio is call it 13. There's a standard deviation, 13. So it's got more torque than the S&P, more torque than the benchmark, but ultimately long-term return on it has also been 12.9%. Excuse me, I mean the wrong number there. Yeah, there's a standard deviation right there. It's 12.2. Yeah, long-term return for it has been for the portfolio has been 13%. So 12.2 standard deviation for growth. That standard deviation I wouldn't measure. Well, so the quant strategy is showing standard deviation of 20. That's a very short term, so I'm not going to accept that number. It's not enough data point. But I want to find the balanced mandate. I'll show you, or conservative. So 12% standard deviation on growth. On conservative, which has half as much stock as growth does, standard deviation should get cut in half. What it did, it went from 12 to 7.5. Not bad. I was hoping not bad. So it did something to lower standard deviation, but it's still 7 standard deviation. Am I right? No,
that's just
8, right there. There it is. Yeah, 7.6. So it did lower the variance. And again, what standard deviation is, it's price movement away from the mean return. So whatever your average return is, standard deviation is how far away from that average will the portfolio fluctuate. If your average return is 10% and you have a standard deviation of 5%, that means on any given year, within one standard deviation, or 66% of the time, your portfolio will have a return of 15% or plus 5 if you have a standard deviation of 5. So movement from the mean. This Stats 101 revisited. Sorry for that. Anyways, I've been chatting with you for 50 minutes. I do want to thank you for your time. As I said, portfolios are doing amazingly well. Our proprietary unique process that we have concocted is working. I want to own winning stocks that are going higher and get out of losing stocks that are going lower. And all I want to do for each and every one of you is make you money. If I do that, you're going to be happy and allow us to continue to remain focused on compounding your wealth. Please, any questions, let us know. Jack, do you have anything like that?
No, that's good. Thanks, Will.
So once again, everyone, thank you very kindly. You know how to get a hold of me anytime. Always here for you. All the best.